Greetings to you. I get a lot of queries on my website because I'm always writing or blogging on economics, fiat currencies, banks, so on and so forth. I know that many of you have my book, The Magic of Banking, in its second edition now. Some of the graphics are a little bit out of date now, a few years out of date, but the principles are all the same. Nothing has fundamentally changed. So most of you know my views. Now, it's a long time since I've been in the financial service industry, 20 years in point of fact, and I no longer hold a practicing certificate, so I don't give financial advice. It isn't my role, but I do feel that some people are entitled to an answer when they write to me. And a sponsor has so done. I get so many of these, I felt I really needed to deal with it. And he's very kindly given me permission to read his email to me and, of course, remaining anonymous. He goes, 4th of July approaches and economically who knows what will happen. I'm looking for a view on what to do with the fiat savings that I have. I'm invested in gold a few years ago now, thanks for that steer, but I would like a rounded view on what to do with my other savings. Principally, my savings comprise of premium bonds, 30,000, ISA account, 20,000, stocks and shares, mainly energy companies, BP, Shell, some ETFs, all in all 50 grand, and a Danksbank savings account with a low return of 22 grand. If the fiat world collapses, then all the aforementioned get leveled. Gold is safe. Not expecting a precision answer now, but be interested in what your thoughts are. My father and mother want to bequeath to my kids a sum of £100,000, and I'm really struggling to decide how to handle that sum safely. Any thoughts would be gratefully appreciated. This is such a typical letter or email that I get. It's so typical. I feel I need to address it. But I'm not giving financial advice. I just want to give a general view of what I think this subscriber should be doing and thinking. And it's the same for you if you're in broadly the same position, if you are in sort of Middle England, professional man in here is in his 50s. So this is my response to that. And I'm going to go through it in a little bit of detail here, so I can help you make your own decision. Now, in the old days, there would be financial advisors around, and they were got rid of by the banks and regulators and all the rest of it. So it's difficult to find independent financial advice. You can find a schoolboy or schoolgirl at your local bank, no doubt, who's done a fortnight's course. But we're living in difficult, uncharted waters at the moment, and I think you need a bit more of that. But at the end of the day, only you can make these final decisions for you and your family. So let me just go through this one by one, and you can contemplate. Let me go in the order which he raises the points, which I don't think is unreasonable. Premium bonds. He's got £30,000 worth of premium bonds, and so have many of you. And let me just have a word about premium bonds. First of all, they are, as far as paper investment goes, or paper savings, arguably the most reliable because it is government backed. So that doesn't mean to say governments can't go bankrupt, because they can and they do. But it means that your counterparty risk is actually the government. So that's probably the safest thing you can do if you're dealing with paper. Now, what is the yield on that, just out of interest? Well, as you know, Ernie selects your premium, and you might win, you might lose, and you don't know. And it's a bit of a lottery. It's a bit of fun. I used to hold premium bonds myself, but they are a short-term, or relatively short-term game. And why is that a short-term game? Well, the prizes you can get are based on the medium gilt. So say the medium gilt is 4.5% or 5%, whatever it is. Okay, that's your medium gilt. That's your government. That's your government bond. They then, if they've got X billions pounds worth of premium bonds, they will distribute the equivalent of the gilt yield, which is 4.5% to 5%, whatever it is at that time or that year, in prizes. So under the law of random numbers, as it were, you should eventually get your 4 or 5%. You might get lucky early, you might get lucky late, and be that as it may, and you all understand that. It's not complicated. But what you've got to understand, of course, is if we have inflation, which is the invisible tax, which most people don't understand how it works, and it's because your money is being degraded. And it's constantly, paper money is constantly degraded quite deliberately by government so they can spend money that they don't have, and it's made out of thin air. And I've talked about this in many, many occasions, and my book covers it, and I've covered it in blogs and covered it on my website. So if inflation is running at 5% a year, let us say, the coupon on your premium bond will be broadly in line with that figure, and so it stands still. If you reinvest your coupon, you reinvest your dividend. But you must make your own decision on what you imagine inflation to be. All right, you've got to make your own decision. Now, the government will tell you it's 2.5% at the moment, or 3%, so on and so forth. But they manipulate it. CPI is permanently, Consumer Price Index is permanently being manipulated. In the old days, it was RPI, Retail Price Index. And they take stuff out which is going up, and they put stuff in which is not going up quite so fast. Give you an example, and you'll have millions of these yourself. I went to the Co-op the other day, and on my little diet, I'm allowed 2 squares of chocolate, proper chocolate, 85% cocoa, proper chocolate, dark chocolate. I'm allowed 2 squares of that. Co-op used to do a very good deal. It used to be £1, a bar of that was £1.10p. And I went in the other day, I was quite shocked to find it's now moved to £2.10p. So it's nearly doubled, i.e. in the last year, that's 100%. My motor car insurance premium has gone up by 80%, and so on and so forth, and the shopping basket and all these things, you can make your own assessment. Of course, inflation is what it means to you. So one person's inflation is not the same as another person's inflation. So an old geezer like me, my inflation, because I don't buy anything, I've got everything that I need anyway. The only thing I buy is beer in significant quantity, I have to say, and a few holidays here and there with the dogs, but we take a cottage, so it's no really big deal. However, if you are in middle age with teenage children, your inflation profile will be completely different because you spend money on different things, you do different things to me. And if you've got young kids and you take them to centre parks and all the rest of it, you'll be seeing the pain. You take your kids, you've got a couple of kids, and you take them out for a lunch or something, whatever it happens to be, you'll know you won't get away with anything less than 100 quid. And the reason I know that is because I've got some young friends who tell me so. And of course, if you're a student, it's all sorts of different things. You probably then behave like old people like I do and spend your money on beer, all jolly good too. But of course, you're racking up a debt. So inflation is what it means to you. But when you've got a situation like this, you have to say, what are those premium bonds for? What's their role? What's your time horizon? What's your risk profile? So you have to make that very clear to yourself. What you do know is if you hold premium bonds for any significant length of time, you will lose money because the coupon and interest you get never matches the degradation of currency. It just doesn't. Trust me on that one. Look it up. By all means, look it up yourself, but you'll find that is the case. So that's not a sound investment unless he wants something very safe for maybe 1 year or maybe 2, and then premium bonds are perfectly okay. Let me move next to the ISA account. £20,000 in the ISA account. Now, your interest on an ISA, let's assume it's a fixed interest ISA. Let's assume it's fixed interest. It's tax-free. That's good. There's no capital gains tax on it. There's no interest in the income. But again, you have the same problems you had with premium bonds. The coupon given by a bank or whoever runs your ISA will not cover in the long term the degradation of the currency. It just doesn't do that. It won't do that. It can't do that. It's not designed to do that. It's okay for a couple of years, but if you do for too long, you'll find that it doesn't wash its face, as we used to say in the city. So the interest won't cover the degradation of currency. Now, there's another thing here. There's another thing which is not like premium bonds, where the government is the guarantor of last resort. You have a bank. You have a bank. So you have a counterparty risk. So you have a risk situation, a counterparty risk. So your bank is responsible for your ISA. But of course, your bank can go down. Your bank can collapse. And we saw that in 2008. And the deposit guarantee people stood in, the government stood in and backed it by taxpayer-funded money, which is what deposit guarantees are. And that goes up to £80,000 or whatever it is. But I would counsel you carefully to wonder whether this is really worth anything, because the overall debt now for banks, the reserves that they keep, which are pitifully small, means that the banks will be under pressure sooner or later, and they will have to be bailed out by this fiduciary guarantee. It will take time to pay. It'll get time to be paid out. And the only way it can be paid out, your guarantee, is by the government printing the money, which is what they did in 2008, 2009. They have to print the money, which means that the degree of degradation before you actually get it will be quite considerable. So you have a counterparty risk. And you must make your own risk analysis. Do you trust Lloyds Bank? Do you trust NatWest? Okay, the NatWest Bank is owned 30% by the government. The government have a stake in many of these banks. But the government are not prudent. The government have no backing. So paper money is paper money. And of course, it's not even paper now. It's digitally made. So it's electronic money, which is done at the tap of a button. So you have a risk attached to that, a counterparty risk. He goes on to say, of course, he has stocks and shares. He's got BP and Shell. And we used to buy BP and Shell for the dividend, if you remember, when I was a pension fund manager for years and years and years, although I managed fixed interest, but certainly BP and Shell, the kind of things you got for the dividend, so you could pay out your pensions when people came to claim their pensions. You used those dividends, and very good they were. However, you might have noticed that greeny-weeny politics at the moment is all bound up with just stop oil. So there is a political threat. And you know there's a political threat to all this kind of thing because you see that the police never move stop oil protesters because it's government sponsored. They never get custodial sentences. So the government, the outgoing government, the Conservatives, and the incoming government, Labour, the results aren't there when I make this clip, but it doesn't really matter because all governments are hostile to oil. And this is a major problem for our economy in lots and lots of ways. However, it can but not affect the share price. It is bound to affect it in some way. A government hostility to stocks like BP and Shell. Now he goes on to say he's got 50,000, he's got some ETFs, exchange traded funds. Now exchange traded funds are a promissory note. So it doesn't matter that it's gold or it's silver or it's the index of stocks. It's a promissory note from whoever manages the exchange traded fund. They will pay you out based on the computerized value of the ETF and its underlying investments. You don't own those investments. It's a promissory note, so you have a counterparty risk again. This is a problem with ETFs. And it's also now, if you've seen the book, The Great Taking, it's a book by an American, and it's absolutely fascinating. And this is something you almost certainly won't know unless you're a bit of a geeky chap like me who likes to drill down on all these things. And that is that you don't own your deposit in your bank. under the Bank Charter Act of 1840, whatever it was. It belongs to the bank, and their account, they give you an account slip, which is a promissory note. Your money isn't there. That's fractional reserve banking. I've spoken about this before on many occasions. But it's all the same as your stock portfolio. Now, this is something you probably didn't know. If you have a stock portfolio on a platform or run by anybody else, run by a bank or run by stockbrokers, they are the same. They own the stocks. Your trustees to your pension, they own the stocks and bonds, and they give you a promissory note for the underlying value. So you have another counterparty risk, which is something that most people don't even know. They think it's theirs, but it's not theirs. It belongs to the stockbroking house. It belongs to the discount house. It belongs to the bank. They own it, and you have a promissory note by way of some form of receipt. And that's what you get on a quarterly or half-yearly basis. So there's a danger there. Now, my correspondent says here, if fiat currency collapses, everything then is leveled. He is quite right. If we see the demise of fiat currency, which is just paper or electronic money unbacked by anything, it will degrade. We know it's going to degrade. Historically, it has degraded. Unbacked currency always degrades. It reverts to its value, its intrinsic value, which of course is nothing, which is nothing at all. So in the long term, if it doesn't degrade totally down to zero, it's going to degrade to something much closer to zero. And that's why if you're an old geezer like me, you remember when I got my first pint, my first legal pint in 1968 at the Tiger's Head in Chislehurst. It was the equivalent today of 6p, maybe 5p. And then now if you go to the Tiger's Head in Chislehurst, it will cost you £6. That's the degradation of money. The cost of the pint of beer that you have has not gone up. The cost of the car that you drive has not gone up. The cost of the house you have has not gone up. Your money has been degraded. The value and spending power of your money has been degraded. Which brings me on to his next point. His parents want to leave £100,000 or give the children £100,000, and that is a very good and noble and understandable thing. And my grandparents helped me a little bit in the same way, not with money. They bought me a car at 18, which I can tell you was a Mini in 1968, 69 was a very welcome gift. Thank you, Grandpa. And they want to do the same thing. Now, I don't know, he doesn't tell me how old the children are, but let us assume that they're 10 or 11 or whatever it is, and you will be different. It depends. So what is required is something for that £100,000 to maintain its spending power today. So it's worth £100,000 when they come to need it. For whatever reason they might need it, it's still worth the same in spending power. Now, what does that? What is the only thing that can do that historically? If you want to go back thousands of years to find what can do that. And the only thing, of course, and I would say this, wouldn't I, because I'm a gold bug, it's gold. And again, when I lectured at universities, I always held up a gold sovereign. It happened to have a 1905 date on it. It's got no measure, it's not interesting what the date was, but let's say it's, think about 1905. A sovereign in 1905 would buy you bed and breakfast in a good London, Parisian or New York hotel. It will do the same today, because a sovereign today is worth about 450 odd quid or something thereabouts. So it'll do the same today. So gold coins are a preservation of wealth. They are not an investment. They're not an investment. And I every now and again get contact from a Bitcoiner, for example. Bless their cotton socks. They're very evangelical. They say, oh, Bitcoin has done this in the last 5 years. It's outperformed gold and it's by miles, and et cetera, et cetera, et cetera. That's got nothing to do with anything. It's totally and utterly irrelevant. Now, this man, this family, they want to know in 20 years' time or 15 years' time or whatever it is, will the money they have today buy than what it will buy today? Will it hold its value? Now, they could put the whole lot in Bitcoin. Of course they could. And they may turn out to be multi-millionaires in a few years' time. Or they might be broke. It's a very volatile thing. But that's not the point. It doesn't matter whether it's up or it's down. Bitcoin is an investment. And if you got in early, it was a very, very good investment. But it's not a preservation of wealth. Only gold is that, or possibly silver. And you might argue that gold coins, and if it wasn't for the VAT implications, you could probably do quite well if you had silver Britannias and in your portfolio, and that's good too. But the question is, what is this man really asking? What's he saying? How can I preserve the wealth that I have of my family in 5, 10, 15 and 20 years? And there is only one answer. And that it has to be gold, because that's been the answer for 5,000 years. But I say again, it's not an investment. If you want an investment, you have to manage a portfolio, a broad portfolio of maybe stocks, bonds, shares, real estate, so on and so forth. That's an investment, and fine. And that's fine. And I spent up until 65 years old, that's how my portfolio worked. And when I got to in my late 60s, I wanted to preserve that which I had made. And I did that with gold. But it's not an investment. It's stashed away in a lockup in London. And that is the preservation of my family's wealth. I won't get to enjoy it. Of course, I'll fall off my perch. Probably. I'm 75. But I've got a much younger wife who no doubt can squander it and hopefully booze it away. I don't know what she's going to do with it. It's none of my damn business. I'll be in the ground. So I hope that's been of some help to you. But I say again, let me reiterate. Only you can make these decisions for you and your family. Nobody else. As most of you know, my work is very heavily independently research based, and I get my information from all over the world. It would help if you press the subscribe button and the little bell next to it, because the more subscribers I have, the more likely it is that international independent research institutes will share their material with me. It's most helpful, and then of course I automatically share it with you. So surprise, won't cost you anything. Thank you very much.